Now that we finished talking about credit spreads, let's combine them together to form something known as an iron condor. An iron condor is a neutral income strategy. Use this strategy when you don't have a directional bias. I'm going to draw something known as an option payoff diagram, which you haven't really seen yet, but you've seen a version of this. What we have over here on this axis is the profit and loss. So this is positive profit loss. This is negative. So this is basically losing money. At the top is you make money. And then here we have the stock price. So let's say right here is $100. This is 105 and this is 95. And you guys have seen this before, right? I just usually draw it like this. This is the 100, 105, and this is 95. Basically just take this, flip it 90 degrees clockwise, and that should bring you to this one right here. And before I draw it on the diagram, I just want to make sure that I'm very explicit about this. An iron condor combines the put credit spread and the call credit spread, using two different colors so you can see what's about to happen here. Let's say you sell a put credit spread with a short strike at 95, and then you buy the long strike at 90 over here. Similarly, let's say you sell a call credit spread at 105 strike price, and then you buy the 110 strike over here. So if the stock stays between 95 and 105, you make a profit. So if you look at this line, it's on the positive side of this P&L chart. So that's what this profit means. If the stock goes below $95 at expiration, your P&L is actually going to decrease. Same thing here. As the stock goes above 105 at expiration, your P&L is also going to decrease. You notice that? That's what this minus sign is. Between 90 and 95 over here, you're going to start losing money. Similarly here, between 105 and 110, you're going to start losing money. But the thing is, because you bought these protections at 90 and 110, you have a max loss, and so your P&L does not decrease anymore. So again, this is an income producing strategy, but it's a neutral strategy. As in, if you think the stock's going to stay between 95 and between 105, it's a great strategy because that means you get to collect money as long as the stock stays between $95 and 105. But if it continues moving in either direction, just know your losses are capped because you bought these long legs as well. So that's iron condor. Now let's take a look at its cousin. It's called the strangle. And I call it a cousin. I don't know if it actually is, but the whole point is that it is also a neutral strategy. You want to use it when there's no directional bias, but instead of combining the put credit spread and the call credit spread, it combines the naked put and the naked call. So let's redraw that P&L chart right here. Again, stock's at $100 right now. You sell a put option at $95. Then you sell a call option at $105. Again, the P&L chart is like this. You make money as long as the stock stays between $95 and $105. Of course, you start losing money if the stock goes above $105, and then you also start losing money if the stock goes below $95. Now, the only difference between these two, and it's actually pretty significant, is this leg right here. You notice how the risk is capped on the iron condor? As for the strangle, it's not capped, as in theoretically, you can lose an infinite amount of money. If the stock goes from $100 to $1,000, you can lose a ton of money on this leg. That's why we prefer these risk-defined strategies, but I want to let you know that as you do grow your account, you could do strangles, but I don't necessarily recommend it when you're first getting started. Just know strangles have undefined risk, and iron condors have defined risk. Really quick recap, the iron condor and a strangle are very similar except for one major factor. The strangle is an undefined risk trade, as in the stock can go either direction and you just kind of have to foot the bill. As for an iron condor, it's a risk-defined trade, as in you know what your maximum loss is. So I'd recommend staying away from strangles until you get very well accustomed and understand how options work, understand your risk tolerance, and really play around with the defined risk trades first. If you have any questions, just leave a question in the comments below and I'll be more than happy to answer. I'll see you in the next video.